Welcome Temple University, Japan's campus first event of the year. We are extremely happy to welcome you. We see we have a very big crowd, which indicates how you're interested in listening to, well, Peter, our speaker, is here. And before, just a few points of order. If you have a mobile phone, turn it on vibrate or silent or whatever. We are recording this, but during the Q&A session, if you don't want your voice to be recorded, just don't use a microphone. And if you didn't get an invitation directly from us, give me one of the student workers your business card and it'll be added to the list. So Paul Scalise, our adjunct fellow, will say a few words.
Good evening, everyone. My name is Paul Scalise. I'm a non-resident fellow here at ICAS, as well as a research fellow at Tokyo University. I've been asked to introduce tonight's speaker, to whom many of you already know quite well. Peter Tasker, a British national, has been on and off in Japan since 1977 for the past 35 years. He's held several different roles. From 1983 to 1998, he was Dresdner Kleinwort Benson's equity research strategist, who was voted for 5 consecutive years in a row from 1992 to 1997 as the #1 strategist by the Nikkei Shimbun. He left Dresdner in 1999 and was the founding partner of Arcus Investments, a hedge fund which deals with value stocks. He's also perhaps known more widely for his several fiction and nonfiction books, including Inside Japan, published in 1987, The End of the Japanese Golden Era, published in 1992, which was on the bestsellers list and sold over 100,000 copies. He has been a long-time columnist for Newsweek Japan, on and off, and as occasional columnist for the Financial Times. And of course, he writes a series of noir novels translated into 4 different languages about his anti-hero Inspector Mori, which I think some of you might have read, Silent Thunder, Buddha Kiss, etc. So please join me in welcoming Peter Tasker as he discusses tonight's topic, Turning Japanese, the Eurozone and the World.
Thank you, Paul, for that very generous introduction. I don't actually tell people anything about hedge fund these days. It's actually kind of, I want to say that. I usually say I'm a consultant. I just thought I said I'm a consultant. Well, today, this evening, we're going to talk about Japan, the Eurozone, and the world, and it's going to be fairly gloomy, I'm afraid. And I feel quite bad about this because it's New Year, and it's really traditional to say something very upbeat and positive about the year ahead, so we can move forward in a positive frame of mind. So I racked my brains quite a while, and I came up with this. Japan is looking better and better compared to everyone else. Okay? And, you know, in the 1990s, Japan had a bubble burst and financial crisis, growth came to a halt, had a banking crisis. It seemed that the rest of the world was constantly giving Japan advice on what to do. You've got to let these zombies go to the wall. You've got to reform, deregulate. You've got to change the financial system, change the employment system. You've got to turn everything upside down and be more like us, then it'll be okay. So that's what Japan was told. Well, they don't say that anymore. So that is the positive that I hope you can all of us here in Japan, by choice, presumably, can take the take-home from tonight's talk. So now, straight on to the gloom and doom. So when we talk about going Japanese? What does it actually mean, turning Japanese? Well, what's happening in the world today and in Europe is a great deal more complex than what happened in Japan. But if we just think of it in very simple terms, you have the bursting of a bubble in the early 90s. And of course, the scale of the burst of the bubble depends on the size of the bubble in the first place. And in Japan's case, it was an enormous bubble which comprehended the real estate market and the stock market simultaneously. I'll go on to later to point out some of the differences, but the fact that it was simultaneous in Japan was very important. The stock market in Japan throughout the 70s and 80s and the real estate market had been highly correlated. So when the stock market collapsed in 1990, it became pretty obvious that the real estate market was likely to do the same. And the real estate market in Japan was also quite unified in that housing and commercial real estate had moved in lockstep on the way up. So it was a fair bet they would move in lockstep on the way down. So that gets you a whole mess of trouble. How? What kind of trouble is this? Well, the guy who really put this into context and made it very clear what had happened was Richard Koo, who came up with this concept of the balance sheet recession. Now, Richard is very much in demand again all over the world now because we've got something like a global balance sheet recession. What is a balance sheet recession? Well, if you think of a person or a company, you have a certain amount of debt and you support that by a certain amount of equity. If you're talking about your house, you might have your house value 30% of it in the equity that you own, and then the 70% of it is what the bank has effectively, because that's the bank loan that you took out to buy the house. If the house then falls by 40%, shall we say, from 100 to 60, you don't have any equity. It's gone. So what do you do? Generally what you do, let's assume that you're still solvent. You've got a job. What you do is you save more money to build up your equity to where you want it to be, which is probably to build it back up to 30, the 30 that's now gone. So that means you spend less. That's the case for an individual, and it's equally the case for companies. So companies that, because of a fall in asset prices, see their equity diminished, or in some cases wiped out, need to improve their cash flow, just as individuals do, and that means they do less investment. So they have more free cash flow and they can build up their equity. So you can see that this happens on an individual basis. It could happen to a person or it could happen to a company. But what happens when it happens to the entire private sector of an economy? So you're talking about the household sector and the corporate sector in general find that their equity is significantly diminished. It's gone down a tremendous amount due to a big fall in asset prices. Well, you need to increase the savings in the economy, reduce the spending, reduce the investment. That creates a slump. So then you get into big trouble. If you do nothing, then you get into a 1930s situation. Well, Japan didn't do nothing. They did a number of things. They put on some fiscal packages, and the Bank of Japan was cutting interest rates, though woefully late. But eventually, if your private sector is now creating a surplus in order to pay down debt, the public sector must go into deficit. Because if we all in this room pay the money that we owe back to the bank, what is the bank going to do with that money? It doesn't dig a hole in the ground and stick it there. It has to put it out somewhere. And generally what happens is they buy government bonds. So the government has to issue more bonds to accommodate that. Now this is actually a pretty simple concept, but it's not always well understood. And you often hear people say something like, you can't cure debt with more debt. You can. It's the only thing you can do, because if you do not issue more debt, if the government does not issue that debt that the market is, that the banks are demanding now, because they've received this money being paid back, what must happen is that the savings themselves must be destroyed. And that means people can't save anymore. Why don't they save anymore? Because they don't have a job. Or if it's a company, why can't it generate cash flow anymore? Because it doesn't exist, it's bust. So that's how, if the government refuses to go into deficit, you get a horrible mess. We got some of this in Europe right now. One of the things that happens then is that people say, oh my God, there's all this government debt out there. And the ratings agencies start jumping up and down and saying, well, surely what's going to happen here is that there's going to be some kind of collapse of government finances. And if you just think of it in very simple terms, you think, yeah, they're issuing all these bonds. My God, Japan, half their government revenues are coming from bond issuance. This is crazy, isn't it? And yet, despite this, the market wants more and more bonds. So what you see is interest rates going lower and lower. The debt burden of the government is going higher and interest rates are going lower. What that means, the demand for bonds is outstripping the supply. You have that. Next thing I've mentioned here, policy appears to have no traction. As we know, Japan had pretty undistinguished growth in the 1990s. Though, if we compare it with some of the other examples in the world now, you can see it could have been a lot worse. But all the fiscal packages that they introduced, and monetary easing to the extent that they did it, didn't actually regenerate any growth. Very, very minor, sporadic recoveries, which soon petered out. So people then said, well, it just shows the policy isn't working. A bit like now, in the US, people say, well, Obama, he put on all these packages, he did all this fiscal spending, government spending, it didn't work. Look, we've still got high unemployment. Well, that doesn't mean it didn't work necessarily. It could have been a whole lot worse otherwise. And what has tended to happen is that when the government stimulus does stop, it does get a whole lot worse. So policy appears to have no traction. What we should say is it doesn't have the necessary traction to get the show back on the road again. Why not? That is a very important question, and I don't think anybody really knows the answer, but I'll make a few comments in that direction. As you get lower growth, nominal growth in the economy, debt becomes a serious problem. Not so much for the government, as we've seen. The government, there's a demand for government paper. But in the private sector, debt becomes a problem. And companies suddenly find their revenues are falling, stagnant or actually falling, but their debt, outstanding debt, is getting higher. So you get a deteriorating credit quality within the economy as a whole. The bad credits get worse. The good credits get a little bit worse too. Everybody concentrates on the bad guys and says, well, you know, these fellas are almost bust. Why should the bank support them? Tell you what, let's just put all those guys into bankruptcy. And then what? Well, then they're bankrupt. The economy's smaller. Congratulations, you just shrunk the economy. But anyway, that's the situation you get into. Deteriorating credit quality. ultimately, when credit quality deteriorates sufficiently, the quality, obviously, the bank's loan books gets into trouble, and then you get into a real mess when you get a banking crisis. And banking crisis these days can happen at any time. It's not like in the old days when you get depositors lining up outside a bank wanting their money back, as in the 1930s. It's when their counterparties in the financial system say, we're not dealing with these guys anymore. They may not honour the contracts. Forget about it. And then when one counterparty does that, it spreads like wildfire, and they're gone. So that can happen at any time, which makes, again, what's happening in Europe, where you've got severely undercapitalised banks, very serious. You could get into this situation at any time. As time goes by, you get a sort of self-reinforcing cycle, circle or cycle. Because people say, well, this is going nowhere. I'm a company. I'm going to reduce investment because there's going to be no growth. And to some extent, individuals say, well, you know, I'm not going to buy a car. Big expenditure. We'll just run our cars for much longer. That's what's happened in Japan. The average lifespan of a car has extended from what used to be quite short now to very, very long time now. And also the number of units sold in the domestic market has fallen very significantly. So people tend to stay clear of these big consumer durable items, the really big ticket ones that are worth several months' salary or a year's salary perhaps. Well, then what happens? Nothing. We just get older and we keep thinking it's going to get better, it's going to get better, but it doesn't, because time passing doesn't change anything in these circumstances. Normally, if you've got sort of a growth environment, just time passing makes things better. China had a terrible banking crisis in the mid-90s. I don't think they actually did anything to solve it. But because the whole economy has grown several times since then, just the scale of the problem gets smaller and smaller and smaller. In contrast, if you've got no growth at all in nominal or real terms, or in nominal terms is actually more important, no growth in nominal terms, what's going to happen is nothing. Another year passes, yeah, well, you know, nothing's improved. Got a bit older. Anyway, so that's essentially how I see the situation in Japan, and I just want to illustrate some of this through. This is the Japanese government bond yield, as we know, from the 1990s. In 1990, Japan did not have any fiscal deficit and did not have any kind of government debt problem, but interest rates were 7%. Now it's got an enormous backlog of government debt and a big yawning government deficit, but interest rates are 1.2%. Do you know, all through the most of this last decade, I've been telling people that this is the lowest level of interest rates since Babylonian times, because there's a guy who wrote a book called The History of Interest Rates, and he extrapolated what was going on really throughout human history, and he found that back in Babylonian times, if you kind of translated the various things that they were that they were swapping in those days, you could find that they were interest rate was 8%, 10%, and then you had a period in 17th century Italy when interest rates were very low. Interest rates were low in the 19th century, which was often deflationary, but not this low. So what I used to tell people was Japanese interest rates are the lowest basically in human history. That's another way of saying that in nominal terms, Japan is the best credit, the Japanese government is the best credit the world has ever seen. Can you believe that? No. I see a lot of doubt out there. But that's what it means. They're getting away with issuing paper on the lowest rates that we've ever seen. Until, I'm just going to skip on a few here. Until recently, because now you can see from this chart, we're not even number one in this any longer up here in Japan. Because Switzerland, long tenure bond yields are 0.7%. 0.7%. So what has happened there is that in the world as a whole, as I'll go on to show, we've got a convergence of very low interest rates, except for currencies, except for a very few countries, all in the Eurozone, which don't issue their own currency. They're in a mess. But almost everyone else is issuing bonds at extremely low nominal rates. Just one thing here. You'll notice how long it took Japanese bond yields to get down to 2%. It really took 10 years. From the bubble bursting in 1989, 1990, and then interest rates stayed high for quite a bit, and it wasn't really until the late 90s and the first banking crisis then that we got these very low rates. Are low rates good? Well, if you're Greek, you probably think, yeah, they're good because you don't have them. But generally, no. Bond markets love bad news. They go up on bad news. If they hear the economy's falling off a cliff, great. Bond prices go up. Bond yields go down. So bond markets love bad news. When the bond market is strong, that's not good news. It's bad news. And when it's extremely strong, like we see all over the world now, that's super bad news. Going through what happened to Japan's nominal GDP, as you can see, the first half of the 90s, 1990 to 1995, Japan continued to grow. They were still doing fiscal packages in that time, so they were keeping growth going at a couple of %. And inflation hadn't died completely and switched to deflation. And again, it wasn't really till the late 90s, where the first banking crisis and the Asian crisis, that nominal GDP then just flatlined like dead man in a hospital, just flat. So that looks pretty bad. Notice I'm talking about nominal here, which is including deflation, and we'll discuss later why nominal is important and for this purpose. I'm just going to say though that, you know, again, that's sort of stagnant, the line going sideways. But if we look at what's happening in Ireland, nominal GDP has fallen 20% over the past 4 years. So, you know, it could have been a whole lot worse. Right. So here are some similarities and differences between what the Japanese experience of the 90s and what's happening in the world now, which, as I said, is infinitely more complex. Firstly, bubble. In many countries, we haven't had coincident bubbles. We've had serial bubbles. I'll just explain that. What it means is you don't have all the asset classes bubbling up at the same time. You have one asset class bubbles, busts, and then you get the next one afterwards. So in the United States, for example, we had a huge bubble in the stock market, particularly technology stocks, from 97 onwards, when Alan Greenspan made his comment about irrational exuberance. That was 1997, but it went on for several years after that. The real estate bubble really got going from 2003 onwards. So, situation now, well, they both deflated in the States at this stage, but it's perhaps a longer process, but not as violent when you get these serial bubbles as opposed to coincident bubbles. There's a precedent. When we were in Japan in the early 90s, when we were talking about the stock market entering an enormous long bear market, real estate market collapsing, and then deflation, people laughed when they heard the word deflation. It hadn't been seen in the world since the 30s. Deflation, you've got to be joking. It's like talking about little green men, alien abductions, that sort of thing. It was considered to be complete nonsense. There was no precedent. But now we do have a precedent, which is Japan, to some extent. So we can see that deflation is a real threat, but when you get into it, it's quite difficult to get out. However, the policy response that we see is very different in different countries, depending on their political and social culture. So, speed, efficacy, focus. It was quite interesting when Warren Buffett was over here in November last year. He was asked at a press conference after the financial crisis in the States. You bought Goldman Sachs stock and Bank of America and a few other financial stocks. Would you do the same now in Europe? He said, no way. At that time in the States, there was an absolute 100% commitment on the part of the authorities to do anything to make sure that the crisis was stanched. Whereas, and that meant, of course, that the Fed increased its balance sheet by an absolutely amazing amount, enormous explosion in the balance sheet of the Federal Reserve. The central bank was taking on all kinds of assets onto its book. They didn't care about that. They didn't care about the dollar. They just wanted to preserve the soundness of the financial system insofar as they could. So they came up with this TARP thing. Nobody really even knew what it was, but they said it's a bunch of money, but we can do what we like with this, and we're not going to worry too much about the rules. We're just going to stop this thing getting out of control. Very different. So the US was very focused, very fast, and quite effective in terms of bolstering the financial system by bolstering the intermediaries. Economy is a different question, of course. So when we look at Europe today, we can see quite a different situation, partly because we're talking about many different countries, and they're in various degrees of crisis. Germany, which is the most powerful country in Europe right now, is doing fine. So obviously, very little sense that it's a life and death issue. Other countries, as I mentioned, the periphery, Ireland, Spain, are in a much worse state. Greece in a class of its own. The other thing that's complicated here, talk a bit about this later, is that it's spread now from just being a sort of Japan-type problem into being a wider problem, particularly in the case of Italy. Italy didn't actually have a bubble, and the banks in Italy are in fine shape. Even so, Italy itself, as we can see, has been semi-locked out of the bond markets and is in serious danger of not being able to finance itself. The government in Italy can't finance itself. The companies won't be able to finance themselves too. How can Fiat compete with other European car makers when it's got to pay an enormous price for capital, for loans? Can't. Bank capital, different in different places. Before the banking crisis, global banking crisis of 2008, American banks had a shareholders' capital ratio of around 5%. That means they're 20 times geared, 20 times leveraged, 5%. This is the sort of very most basic form of leverage, forgetting all this BIS rules, different tiers of capital. All that didn't work at all. It was all complete nonsense, it turned out. European banks, some of them, currently have half that. This is 4 years after the crisis. So they have got much weaker capital base. Furthermore, banks are much more important in Europe than they are in the US, because in the US you've got highly developed capital markets and companies, a lot of access to capital markets. In Europe, the banks are still very, very important, and without the banks, you can't envisage, without sound banks, you cannot envisage economic growth. Policy orientation. This is, again, back to that sort of cultural issue. Growth or austerity. My own view is that you can only grow your way out of these debt issues. That austerity just means that the debt to nominal GDP ratios stay or get worse. So it simply isn't going to work. And this is particularly the case when you're in a situation already, as these low bond yields are suggesting, of very low growth anyway. The equilibrium growth is going to be very, very low. Social cohesion. In Japan, wasn't really much of an issue. There was some sort of ritualistic bashing of real estate people and bankers and bureaucrats. No panty shabu shabu and all that, if you remember that. But that was an issue by the media, but it wasn't really a big political issue. But Europe is a completely different kettle of fish. And I don't know if you saw in the newspaper today about the platform of Marine Le Pen, who is standing for the French presidency. And she's come up with a policy platform, which is to get out of the euro, bring back the franc, go back to soft money, in other words, so devalue, get rid of all the immigrants, or keep out the immigrants, tax imports, use the money generated from that tax to pay people on low incomes. So this is a classic populist formula that may be attractive to some sections of society. And in the last French presidential election, her dad actually beat the socialist candidate and got into the way they do it there. They usually have three candidates with the third candidate, and then the last round between two candidates was between the conservative. It's the one before us, wasn't it? The conservative Chirac and Le Pen, the dad. But the daughter is a much smoother operator and is much more saleable than the dad, who's a bit of a rough diamond, to say the least. Anyway, so we could, in the worst case scenario, I think we're going into that kind of world in which the social problems, political problems continue to fester, occasionally explode, and it's not unthinkable, if this thing carries on and proves to be very, very durable, that we get to a situation where you have populists in power or sharing power in many European countries. You have them in coalition governments already, and that the Eurocrat, technocrat elites who've been in charge for the last few decades are completely discredited. So if you talk about Brussels, the euro and that stuff, all that stuff, you'll be voted out of power. And people who come and say, this is what I'm going to do for you, whether it's true or not, people say, well, hey, let's give them a chance. As I said, it took 10 years for the Japanese bond yield to get down to 2%. Well, the US bond yield is there already. Remember, bond markets love bad news. It's not a good sign when you get low bond yields. And this is the state of the world now. Number 9 is Brazil. Brazil's supposed to be this fast-growing economy. If it really was a fast-growing economy, they wouldn't have bond yields at 3.4%. I mentioned the Swiss situation, which is they've actually dipped below the Japanese previous Guinness Book of Records bond yields. Right, so just to wrap this up, there's a lot of uncertainty and risk out there, and nobody really knows what's going on. The people in charge don't know what's going on. They rush around from summit to summit looking energetic, but they've got no clue. But we're in the markets, we don't know either. If we knew, we'd be making money. We don't know. There are a lot of quite important issues that need to be resolved. One, as I put here, you know, the entire post-war history in economics has been this debate, endless debate between the Keynesians and the monetarists. And they've been at it for 50 or 60 years now. Keynesians were in the ascendancy in the 50s and 60s. The stagflation of the 70s made them lose credibility. And then you got the monetarists, Milton Friedman, etc. They seemed to have a methodology for reducing inflation, and that seemed to work. So then they were in the ascendancy. But now they don't look so good either. And then both the Keynesians and the monetarists, in a sense, they're sort of optimists, because they believe if you follow what they say and you follow their advice, things will get better. But then you've got the Austrians, and they don't think that. They basically think it's not going to get better anyway, so what the hell? I'm simplifying a bit, but that it's all organic, natural processes, and that intervention, policy levers being pulled, is going to have a limited amount of success. We haven't heard much from these guys because nobody wants to listen to them, because it's just such dark stuff, ultimately. And they're certainly not going to get a job in government, because the whole idea of government is that you can make things better. If you want to be a politician, or you want to be a politician's advisor, you better say, do this, this, and this, and we can really make a difference. He says, well, you could do this, but it isn't going to work. Do this, yeah, you try it, but it's not going to work. That's not really much of a recipe for success. But at the moment, it's 2-0 to the Austrians, I'd say, in this particular branch of where we are so far in this crisis. Policy effectiveness, as I said, I don't believe that policy is totally ineffective, but it's not able to make the real economy better. It can mitigate the damage. So the third question is there a super cycle at work here? When we look at the debt to GDP ratios, not just government debt, but all debt to GDP ratios of countries, we can see that there's a multi-decade cycle in which debt has been accumulating. And if we've reached the top of that cycle, deleveraging one way or another is going to go on for a long time, what does that mean? Does it mean that all the levers that we pull will have some effect in mitigating the worst of the damage, but ultimately this deleveraging process is going to go on for a very long time? Economists don't like this concept of super cycles generally. In the stock market, people do believe in super cycles, but it's kind of slightly mystical. It's like sunspots. It's a little bit cranky. Is deflation good? At one point, the Bank of Japan was saying that deflation is good. Prices of things are falling. That's got to be good. Now your cell phone is much cheaper. What's the problem with that? Well, clearly, when you get to a sort of a macro deflation, where everything is falling in price, It's no longer the result of the productivity increases. You've got something that's more malign. But nonetheless, you go back to the 19th century, we had periodic, long periods of deflation. Didn't seem to do a tremendous amount of damage. There was real growth, even though the general price level was falling, there was real growth. What's different this time? Well, what's different is that we now have this huge complex financial system with all these nominal claims. Now, if you were to say, we'll deflate everything, including your money in your pocket, so every year this 10,000 yen note in your wallet goes down in value 2%, and bond yields have got a negative slide on them, so your bond value goes down too. Everything goes down 2%. Maybe it wouldn't matter. That's possible. But that's not what we have at the moment. What we have is a situation where certain instruments, like bonds and cash, basically give you a free lunch. You earn in Japan 2%. Deflate is around 2%. You earn 2% real on your money by doing nothing. So you can just carry on earning by doing nothing. You're not penalized. So doing nothing becomes the right thing to do. The people who actually try to do something, borrow some money and set up a business, or borrow some money, buy a house, or reform their house, they find that they're paying money, effectively subsidizing the people who are just holding the money in their wallets. So deflation in a complex financial system with lots of debt is malign. It's not like the 19th century. Going back to the euro. The euro is a political project to unite Europe, brought in by the elites, the political class in Europe. And it's quite obvious that the various countries all had completely different economic characteristics, and putting them together wasn't going to result in what they call an optimal currency area, because there were no transfers of people or money, tax revenues, etc., from region to region. And there was too much autonomy for the individual countries. So that could not work in the long term. At some point there was going to be a blow-up, and here we are, we got the blow-up. But I think everybody realized that there was going to be a blow-up at some point, because the only way to deal with the blow-up is to actually unify more. Because there's no escape clause from the euro. Once you get in, you can't get out. It's like the cockroach motel. You can check in, but you can't check out. Why not? If you try to check out now, there would be a massive Europe-wide banking crisis, contagion, as people, fearing that their deposits denominated in euros were going to be denominated in drachmas and pesetas, etc., pesos, they would immediately take their money out of those banks. So you would have massive runs on the banks by individuals and by companies. Okay. So I think we're going to move on to the discussion here. I'm just going to leave that as a summary. But we have the risk of a long-term crisis of growth, jobs, and perhaps political stability. The Eurozone is most vulnerable because it's got the least capitalized banks, it's got the least growth, and it's got the least growth-orientated policy. Banks have not done any deleveraging yet. Deleveraging in the Eurozone, actually since 2008, bank lending is up about 5 or 6%. In the UK, it's down 12%. That's deleveraging that happened. If you just do deleveraging of the banking system, loans down 12%, you get an almighty collapse in the economy. You have to offset that through massive deficit spending financed by the banks, which is what we've had with these so-called quantitative easing. Okay, well I think I'm going to stop here and we'll move on to the question and answer as I've grossly overrun my time. Paul.
Okay, I think, thank you very much, Peter, that was excellent, and I think we can open up for, what, 45 minutes?
It's a free country.
It's a free country, so we can go as long as Peter is standing. Yes, sir. Do we pass the microphone? Is that how it's going to work? Are you going to do it? Or?
Yeah, I could do it.
So it's this gentleman over here.
Isn't that this crisis will it not be in the end produce this European nation, like it or not, with all the institutions that are missing, seem to be coming as part of partial solution? Don't you have? How did it happen in the US anyway?
Maybe, I don't know. That's one plausible outcome. But for that to happen, as in the US, you have to have fiscal transfers in which the rich parts of the Eurozone transfer their wealth to the poor parts, like in Italy, where the north subsidizes the south. So the rich north of Europe will have to subsidize the south. But they don't seem to want to. And, well, that's the problem we have at the moment in that this transfer of wealth, which in the US is actually semi-permanent. It's not large scale, but it's semi-permanent. And also the internal immigration that you need as well, for people to move from one place to another. It could happen. I mean, Italy does it, Germany does it with East Germany, but Germany doesn't want to do it with Greece. They complain about it. So that's the problem we have at the moment. But maybe that's where it's going, yeah.
So first of all, thank you for that vivid description about the Eurozone crisis. I'm Vikash from India. My question is, every crisis is in fact a hidden opportunity waiting to be explored. So goes the old adage. So in this scenario, where do you think is the opportunity, or where do you think is the upside or the silver lining, and who do you think would be the benefactor?
Well, there are a number of different paths. If, for example, Greece leaves the Eurozone, it will be very traumatic in terms of bankruptcies and insolvencies, because they've got all these contracts, debts and everything denominated in euros. However, if they were to devalue by 40–50%, they would become very competitive again, and then they would grow. So this is generally, when the IMF used to go into countries, that's what they would generally recommend, was be a very substantial depreciation to make the countries competitive again. So if countries leaving the Eurozone could well actually, they could be the biggest beneficiaries, I think. If they stay in, they could become wastelands.
Is there someone in the front? I think, yes, this gentleman over here.
Yeah, hi.
What do you think is the number one lesson that Western nations could learn from Japan's experience?
As I said, to some extent, this is a lot more complex than Japan was kind of. Japan is a kind of template. What we're seeing here is it's got much more sort of complexity and hidden depths to it. But ultimately, I think one of the very important conclusions is don't get into deflation. If you get into deflation, it's very difficult to get out because expectations change. And when that happens, you can't really you can't really reduce debt. Debt is reduced by high growth, actually, and sustained growth. So I think that's one lesson. But who else has got some lessons? If anybody's got, a statement, that they've got a solution. If you've got a solution, let's hear it. Or something that you think, what do people think is the lesson from Japan? Because Japan is as I hinted, has got more social capital. So as a result of that, you don't get, you haven't had a lot of social malaise and riots and interestingly enough, you didn't even get any real banker bashing and financial institution bashing in Japan because their system, which created the bubble, was not basically a free market system. It was a bureaucrat-controlled, highly micromanaged system. There were no investment bankers earning vast sums of money, no hedge funds, no options, no bonuses, none of that stuff. Nobody earned much money, but the whole thing was actually even worse. So what they took home from that was that they should actually liberalise their system. They moved slowly towards a more liberalised system in which you've got now, like banks, for example, can do all kinds of things. Previously, all they could do was lend money. You can get into an awful mess just by lending money. You don't need derivatives to get in a mess.
Let me take the privilege of owning the place to ask a question. You've mentioned social capital as a Japanese asset, and implicitly saying that if Japan had been a Western European country, there'd have been riots, there'd have been something. If one assumes, and I can agree with you, that the solution at one point is Keynesian, that austerity doesn't work, is social capital an asset or liability? In other words, if Japan were more like Greece or Italy, would there have been a policy U-turn faster?
That's a very good point, and I think you're probably right. Yes, there probably would have been, and it's because the public is so well behaved that there was no risk to the political class in just continuing with business as usual. Yeah, I think that's a very valid point. Can I just add? I just thought of something I should have said before, which was when you talk one lesson. One lesson is that it's not a great idea to have a whole load of young males between 14 and 40 unemployed, right? That's not a good thing. And Japan has sort of got around that by introducing this part-time system and making the labour market more flexible. So you've got downward adjustments to wages, which means that you can have, although there is pockets of hidden unemployment in Japan, it's never been a huge problem, and you don't have, therefore, the problematic testosterone-charged youths with nothing to do all day.
Yes.
Hi, over here, sorry. Could you explain possibly the strength of the Japanese yen at the moment, given its stagnation, and also the position of the UK, considering it stepped out of the Eurozone in terms of currency?
Well, in relation to the yen, because Japan has deflation, it means that the real interest rate, which is it's negative, is maybe 1, 1.5, 2 on just holding yen. So if you've got deflation and the rest of the world doesn't, you will probably have a strong currency. Whereas in the US or UK, the real rates are actually very low because you've got inflation still there, but interest rates are low. So you're really getting, if you're an investor, you're buying pounds or you're buying British bonds, you're getting nothing, really. Whereas in Japan, it's a low rate. It looks like a low rate at 1%, 1.2%. But you're getting another 1%, 1.5% of the negative bit of deflation. So as you invest in that, and that compounds up over 10 years, you get your money back, and lo and behold, it can buy you a whole lot more stuff than it could when you put it in, because everything's gone down in price. So that's why, generally speaking, the internal value of the currency, which is whether you're in inflation or deflation, and the external value, which is how it relates to other currencies, are related. So a country with deflation will have a strong currency, even though it may be not growing. Your other question about the euro, yeah, we're not in the euro, and we are in, we've got all kinds of problems, but they would have been a whole lot worse if we were in the euro, because we'd have been like Ireland.
I think Thomas had a question.
A couple questions. First, an observation. It seems to me you haven't painted the picture black enough. I mean, we've left out China. We haven't talked about all nations, driving down their currencies and currency wars. I mean, we're looking at potential breakdown of, the global settlement system based on currencies breakdown. So we're looking at, the Great Depression and, the things that led to inabilities of countries to trade, which led to, the Pacific War, the European War. Maybe you can comment on China and some of these other factors, one. Secondly, this relates to your comment about Keynesians versus monetarists and Austrians, and the political science of moral hazard, which means people making policy subscriptions who have don't own the downside. They don't have the skin in the game. All of us do. And that ties back to this observation about social capital. I mean, docility in the face of irresponsible leaders and advisors is not social capital. I mean, people are finally starting to believe. I mean, we've had a Tea Party movement, an Occupy movement. People in Japan starting to get restless. We have the Muramuri Kombi. We have Hashimoto. People are getting restless. That's a good thing. That's not a bad thing. But sitting around is not social capital. It's time. I mean, that's why people are here, I think, because people realize, hey, I can't serve them. So as to the Keynesians versus the Austrians, or the monetarists versus the Austrians, I think probably very few people in this room have even heard that term. Perhaps you can describe who the Austrians are and what do people like Peter Schiff, Gerard Salente, Robert Murphy, these other guys say about what we ought to be doing. Perhaps we could hear, you said they're up 2-0, or I'm not quite sure I understood exactly how that meant, but maybe you could give us some idea what they're suggesting, since the other ones are not working.
Yeah, well, they're all dead.
They're not. Check out the von Mises Institute website.
Well, von Mises, Schumpeter, and Hayek are somewhat different in what they have to say, but those are they are from Austria and are referred to as the Austrians, and they're very anti-socialist, anti-government intervention, and believe that all government interventions have unintended adverse consequences, and that the economy is the result of numerous decisions taken by innumerable swathes of people, and that's what results in what happens, and it's an organic creature, and if you start distorting it, you make things worse. That's essentially where it comes from, and then there's also a debate about the gold standard, which is not necessarily the same, but that's part of it. Because if you've got a central bank that's very activist, that would be considered to be a a form of government intervention that could have adverse consequences.
Do you disagree with that?
I do somewhat, yeah. I think that to do nothing is actually quite dangerous, and the downside of doing nothing is of a much worse fall-off in economic activity.
If I could rephrase that, to do nothing, it means stopping doing stuff that's destroying the economy. So stopping people who don't own the downside from doing something. That's not doing nothing.
Well,
it's taking action to stop people who are destroying the economy.
Okay. Well, that's certainly one way of putting it. Yeah, that's certainly one way of putting it. But if the U.S. authorities had not come in, moral hazard you mentioned, if they had taken moral hazard seriously, and they would not have bailed out AIG, Citicorp. I mean, you're talking about some humongous financial institutions. If they go down, the world is going to be a completely different place.
Might be a more responsible place.
Maybe ultimately, but it's going to be a hell of a mess in the meantime.
So we're going right now. You didn't mention China. Can we talk about China for a minute? Sorry.
Well, I'm not sure I've got any particular insights on China that other people don't have, but they also have a risk of a hard landing to their economy, though it's a different type of risk from what we're seeing elsewhere. And it's basically a risk of structurally high wage inflation as they run out of new workers, and therefore a downstep in growth. As we know, they've got a very large amount of fixed public investment, much of which is mandated by local governments for various reasons, which there is sometimes said to be as much as 48–50% of the entire economy, whereas consumption said to be a third or less. All the statistics are, have to be taken with a huge pinch of salt. But clearly these are imbalances on an absolutely massive scale. So there is a risk of a Chinese slowdown, which would immediately impact quite a large section of the developing world too, as well as all the major Western companies that are in China on the basis that it's going to grow forever.
Thank you.
There's the gentleman in the back, and then June here, and then Tag Murphy has a question, and then the gentleman over here.
Peter, thank you. I'm also from India, but I'm based in Beijing for the last 7–8 years. And I do interact with some local governments in China. So inside China, they are scared of Chinese economy or hard landing, whatever you say. But they say they draw confidence from what's happening in Euro, what's happening in US. So I don't know, I wonder why Euro is willing that Chinese government, which is not very transparent or say accountable to Chinese people, is buying heavily in European market. What is the risk of Chinese investment in European market? That's from European perspective, one question. And my follow-up question is to my friend from India, I think. The thing is that India and Japan are still not very comfortable with Chinese currency, yuan, emerging the strongest currency, say, at least in Asia. But you see the US Congress, they didn't pass the law that China is a currency manipulator. So what's happening behind the scene in US or in Europe? And what is the future of Chinese currency as a strong or global currency? Thank you.
Well, I'm really going to be talking way outside my competence here. I don't really have the strong feeling about those issues. It seems to me the Chinese currency could go either way, depending on a lot of other factors. It's not impossible it could go down if it were freed up. That's very difficult to say. What they've done by holding their currency in the face of very, very easy money from the States, very, very loose monetary policy by the US, so, and the Chinese peg to that, means that they run an inflation threat. And they've had inflation, and actually their deflator is running at around 10%. As I said, the fixed asset investment appears to be much higher component of the economy than consumption. CPI is sort of 4 or 5, something like that. So we're seeing a big rise in real wages too, and the adjustment is taking place to some extent through that mechanism. And we hear anecdotally about pretty high salaries being paid now to staff in Beijing and Shanghai who are in areas that are, where there's a shortage. But I'm not an expert on China. I don't really want to go too far on that. Sorry, what was your second question?
I mean, in China there's no very clear property rights, so who is investing?
Who's what?
Who's investing?
In Eurozone, and what is it?
Nobody. We're waiting for the Germans to invest. The Eurozone is self-financing. It doesn't need anyone to invest. That is all a shell game to fool the publics, to make them think, get the IMF in and all that stuff. That's all a shell game. The Eurozone is self-financing. It doesn't need anybody's money.
No, it was Julian, actually.
Peter, you mentioned something about the UK that interested me. You said the UK banks deleveraged. Did that have something to do with it? Were they able to do that because they were not part of the Eurozone? And is that somehow a corollary of the fact that Greece cannot devalue its way out of its crisis? And I have a point about the comment about the dead Austrians. Is it? And you mentioned the danger to the Austrians of an activist central bank. Is the gold standard somehow? Isn't the gold standard a way to keep is that a preventive measure against such a threat, and the possibility that the sovereign currency could be used as in a very activist way by the government?
Well, your first question about the deleveraging of the banks in the UK, they've reduced their balance sheets, and some European banks like UBS have also massively reduced their balance sheets. The reason that they've been able to do it is because they had capital injections from the government, and that boosted their capital so they can actually take the write-offs. Now, if you look at Japan, most of the deleveraging took place after the first financial crisis, because the money went into the banks, and then the banks were told basically by the authorities, okay, you've got to clean up your act, and you've got to make your balance sheet look better, and that's the same as we've got in the UK. It's actually incredibly bad for growth in the first instance, but it's maybe an inevitable phase to go through. So who knows where it stops? Obviously, if you've got some kind of top-line growth in the economy, that helps, but we have zero at the moment. Well, that's not quite right. We have inflation of around 2.5–3. So yeah, that's enabled the UK banks to be actually the fastest in reducing their balance sheets. That's because they got the most capital out of the government. Otherwise, they couldn't have done it. And your question about gold, gosh, that's a difficult question. A barbarous relic. According to, well, the thing about gold, the reason that it was discredited was because it couldn't stop a deflation once it got going. It ties your hands. So if you want your hands tied, I suppose it's the right thing.
I guess they want the dead Austrians want to
by the government's hands.
Not all of them.
Oh,
Not all of them.
but they're dead.
They're dead, so they're not.
Saying. I think Taggart Murphy had a question.
Actually, I have an observation and a question. Let me start with the observation and ask whether you agree with it. The discussion between you and Robert about the social capital in Japan and whether it might have been helpful if the Japanese had a little less of it. I would argue that the strong social capital in Japan in the late 90s was what prevented the banking crisis. The banking system was technically bankrupt, but most Japanese kept their money inside the banking system. And if the social capital had been weaker, they would have pulled their money out. Would you agree with that?
I think that's a reasonable observation, yeah.
Okay. The question is, you pointed out, and I agree with you totally, that in a balance sheet recession, inevitably, governments are going to run deficits unless they want to commit political suicide. They're going to run deficits, and bond prices are going to fall. There's a counterpart with that in global balance of payments, which is that as countries, given the current setup, as countries try to export their way out of difficulties and run trade surpluses, the United States will run a larger and larger trade deficit, and yet the dollar will continue to strengthen. Paradoxically, U.S. Fed triples its balance sheet, but the dollar gets stronger. Do you see any scenario in which either the JGB market or the U.S. Treasury market on the one hand, or the foreign exchange markets, particularly vis-a-vis the dollar on the other, could actually be shocked in the sense that there would be some kind of collapse?
Realistic.
Well, let me talk about the JGB market, because that's the one I feel a bit more confident about. I think that as long as Japan has a current account surplus and is therefore generating more savings than it requires to use internally, there will be no sort of malign sell-off in JGBs. Where JGBs are now, even over the standards of the last 10-15 years, is extremely low yields, unhealthily low. They were sort of 1.5 to 2. Now they're sort of trending around 1. That's much too low. So I would consider a rise back up to 2 to be healthy and not a problem at all. And then I know that there are some guys who have been shorting, vociferous investors who have been shorting the JGB. And it hasn't worked, of course. And I find it hard to envisage how it could unless the yen goes so strong that Japan's trade deficit, and as we know, Japan does have a small trade deficit now, the trade deficit is enough to outweigh the entire surplus on the financial account. Well, that's not going to happen, in my view, unless the yen went very significantly stronger. We're talking about sort of 55 or something like that. Then it might. But that would be, it's not going to do that on a sort of Japan type events. So that would need to have something else. Your other question was about the US dollar and the US bond market. Yeah. Well, these things have got a way of self-correcting. The US dollar looks strong at the moment, trade weighted, because of the euro, and the euro is actually too strong even now. It started, as we can recall, at parity with the dollar, and it's fallen from its highs, but it's still 126, 127. So it could fall another 20% without a problem, and still be where it was when it kicked off. So the dollar could be strong by default in that scenario. The yen will remain strong versus the dollar, I think, unless we get a complete change of heart at the BOJ, which, as an investor, I hope will happen. But as a realist, I think you need something very, very significant at this stage of the game to make that happen. So you've probably got what is essentially a euro decline, maybe a decline in some of the commodity-linked currencies like the Aussie dollar, etc. as well. I'm not too sure about the yuan, as the gentleman earlier asked. I don't have a strong feeling about that. A lot of money went into that on the basis that it must go up, and that's always, a bit of a risky deal.
Thank you. The gentleman.
Hello, I'm a student here at TUJ. With what the gentleman over there was saying, with the, I think it's the Austrian point of view, I was wondering what the public opinion is to that approach. I'm studying macroeconomics right now, which is fitting enough. I guess Andrew Mellon, Secretary of the U.S. Treasury during the Great Depression, advised Hoover to liquidate labor, liquidate stocks, liquidate the farmers, liquidate real estate, saying it was a good thing. The slump was happening, that it will purge the rottenness out of the system. High cost of living and high living will come down. People will work harder, live a more moral life. Values will be adjusted, and enterprising people will pick up the ranks from less confident people. So what he was saying about responsibility.
He was a so-called liquidationist. So he's saying liquidate everything, liquidate the farmers, liquidate everything, as you correctly said, a very famous quotation. And it's sort of a notorious quotation because there's a moralistic tinge to it. You get people working harder because basically they're starving, so they have to work harder. And he said liquidate the rottenness. But as we know, in any kind of recession, let alone a depression, which is what that refers to, it's not just what's rotten that goes to the wall. There's all kinds of people who are just doing normal businesses and maybe quite sound. But if nobody comes, if you've got a French restaurant and you may have no debt yourself and you may be a great French cook, but if nobody comes any longer, you're out of business. So, you know, there's all kinds of drive-by victims that aren't necessarily deserving, and whatever that means, of that kind of fate.
Okay, I think we had a gentleman over here had a question, and then we had a gentleman here.
There's a lot of anger in Europe towards credit rating agencies and markets and speculation. How do you assess the fairness of the Standard & Poor's and Moody's on Europe sovereign debt at the moment?
Moody's is irrelevant. So that anger is totally misplaced. I mean, the bond market moves ahead of the ratings agencies who tell us, hey, Italy's in a mess. I mean, if they told us that a year and a half ago, they might have had some use, but they didn't. They wait for the bond market to collapse, and they say, oh, we got a problem here. So the ratings agencies are a sideshow and a distraction. They got subprime totally wrong. They keep downgrading Japanese JGBs, which then go up. So they are not a useful sign to anything. They've downgraded the US, actually. The US bond market was strong after that too, which was, again, a very strange and actually unhealthy sign, I think, in reality. But, yeah, well, you know, you've got to blame somebody, I guess, but these rating agencies, that's like blaming a broken barometer for the storm.
And they downgraded TEPCO. What's with that?
Yeah, Paul, if that was shocking, I agree, that was shocking.
Yes, sir.
Small business owner Sato, my name is. This is a tremendous opportunity to ask this question. I see the continuous crisis, and this will continue for another, let's say, 3 or 5 year time. So if the things got worse, then who is going to rule the international financial crisis? IMF or World Bank or whatever? That's question number one. The comment I like to have from you is the new movement. The political chaos finally found the Mr. Hashimoto as a sort of final power of Japan in the future. And he is thinking about the possibility to chop off the Bank of Japan governor's head. And if this happens, it will affect the tremendously positive way to lead Japan in the future. What are you thinking about this? In other words, the evil guy is Bank of Japan governor.
Well, I've been out of Japan for the past month. I only just got back. I think I must have missed those comments by the Hashimoto. Yeah, interesting. I do fault the Bank of Japan, personally, for its sort of inertia, stasis, doing nothing. And they've basically taken the view that perhaps they're the only Austrians left. I mean, there are no Austrians in Austria anymore. There are no Austrians in Switzerland. They put a hedge fund guy in charge of the central bank in Switzerland.
He's gone. He's gone. He's gone.
He's gone. Yeah, there was a minor problem.
Just before this gentleman, I think Regis had a question, right?
So yeah, what was the question?
He hasn't asked it yet, but maybe you can answer.
My question is, you made the point that there were not many bankruptcies in Japan for a long time, which allowed the economy to still stay as a kind of very big size. But I don't know, but I guess the other side of that is that deflation was created by this, let's say, generosity, because if you price cow the same way you price cannibal, they can finance both of them at the same rate, and they can't increase, and the winner cannot increase the price of its shampoos, and so deflation goes on. So what do you make of that?
Well, I think this is another side effect of deflation that perhaps we're not really aware of, but the difference between a good credit and a bad credit is almost nothing, because the bank pays the public nothing, right? There are no interest rates. You don't have to. The public comes and they put their deposits in your bank. You don't have to pay them anything. They still do it, and then you lend the money out. Anything you get is upside. Even if it's a guy who can't really service his debts, well, why don't you just, leave him for a while to see, leave him on a special interest rate, especially low interest rate or interest forgiveness, just see what happens, because you're not paying for the money. You, the banker, are not paying for the money. You're giving your depositor zero. If you were giving your depositors 5% and the guy wasn't servicing his debt, that would be a 5% hit that you'd be taking every year. But you don't take a hit now. So at very low interest rates, there's not much damage to a bank in not calling in bad credits.
But doesn't it actually nourish the deflation you are...
I don't know about that. I mean, I think it's got long-term malign consequences, because it means you get sort of stasis. Everything stays in place. Nobody appears to be hurting. But I don't know if it's deflationary as such. If you're suggesting, well, if you put them all into bankruptcy, there would be. Can I just say the other thing with the deflation is that there's, particularly in Japan, is that due to the deleveraging, the banks don't really have anybody to lend money to. So even if you've got a guy who's a bad credit, you're going to be quite generous on anything, just as long as he takes the money. Because if he doesn't take the money, you don't have a business.
The gentleman with the tan blazer in the back had a question. And this will probably be the last question.
Sorry, I'm not Austrian, but I have to defend them a bit. Maybe we should replace government with inefficient institutions when we criticize Austrians. They don't say we are against governments. They just argue that they hate inefficient institutions, including governments. And if anybody wants to follow their path, actually, they should let it go. They shouldn't create systemically important institutions, for example. They shouldn't say, hey, look, we are the government and we can guarantee your deposits. In fact, they cannot. We have seen so many deposit guarantee schemes all around the world. None of them work, actually. And the second point, I mean, pulling the lack of Bank of Japan is easy, probably, but we need to be careful in details. It is not it is not correct to criticize them for waiting in front, because they are executing the most creative monetary policy tools at the moment, and they are dealing with exchange-traded funds. But it doesn't mean anything for the central banking. So what is the meaning of central banking in the first place? And I have to admit, I'm a bit confused with your presentation because comparing the Japanese to Europeans, yeah, you could have found much more deeper differences or similarities. But concentrating on the Austrians, I think I'm sort of lost the presentation. Sorry about that.
Okay, thanks for your comment.
Can I just ask, it's all black, black, black. It's death, doom, light at the end of the tunnel here in Japan where we're sitting.
Wait, you might want to stop for a second because the video camera can't.
Okay, sorry. So far we've seen black Darth, Darth Vader sitting there, the Death Star above us. When's Luke Skywalker going to arrive? How do you see the future for us here in Japan? And Japan can't continue at this rate with its yen so high. Will we, having been in stagnation so much longer than everyone else, come out of it first? What do you see as the future in the next 5 to... Everyone said after the American glass crash, it would take 10 years. They got back on their feet much, 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 much faster, relatively speaking. What would you say is the future from now?
Well, I question whether they're really back on their feet. We don't know. I think it's too early to say. And I don't think there are any big pressure points in Japan, actually. So I'm not sure that anything is going to change, to be frank. You said it can't go on like this, but why not? I think it could. One thing we've seen is that it appears to be a feeling amongst the business community and the politicians that the yen should not go much stronger. So the scale of intervention has increased to a considerable level and largely left the money that's been created in the markets. So that has had some, I don't know if it's had again, it's not had a negative effect. They haven't succeeded in pushing the yen down because they haven't given them the sort of message that the Swiss did. The Swiss actually pushed down their currency by saying 120 to the euro, that's it. We'll basically sell Swiss francs, anything above that level, in unlimited quantities. Well, the Bank of Japan is never going to do that. Well, the Ministry of Finance, in fact, is never going to do that. But I think we can expect more intervention, probably with a view to spooking the markets and stopping the markets getting a one-way bet on the yen. I didn't answer your question about the light at the end of the tunnel. I'm going to go away and think about that.
I don't know if you wanted to say any last words. Last rites. Before we take you out back and shoot you. But I'll let you have the last word.
Yeah. Well, it's interesting, isn't it? Because we've had a sort of benign world that we've had for several decades now, and suddenly it's got very stormy and choppy, and it's sort of like living through a piece of history with a great deal of uncertainty and very little clarity. We can't any longer think that the future is just going to be an extension of the past. Anything can happen. So. It might be good, it might be bad, but it won't be dull. I think I'll leave it at that.
Thank you very much.